Stop believing that the wealthy simply know more. They do not possess secret stock tips. They do not wake up with mystical intuition about markets. They are not operating from luck. They are operating from silence. And that silence is not accidental. Here is the pattern interrupt most people never consider. If the wealthy truly wanted everyone to understand how money works, the system would look very different. Financial literacy would be taught before algebra. Its ownership would be prioritized over employment. Cash flow would be explained before career selection. But it is not. Instead, you are taught how to earn money, not how to control it, how to budget, not how to build leverage, how to save, not how to position capital. This is not conspiracy. It is structure. And structures do not need permission to shape outcomes. They simply do. Most people believe wealth is the result of intelligence, hard work, or timing. But that belief is incomplete. Because if intelligence alone created wealth, universities would be producing financially independent graduates by the thousands. If hard work alone created wealth, laborers would dominate capital markets. If timing alone created wealth, lottery winners would remain wealthy for life. Yet they do not. So what is happening beneath the surface? This is where the structure reveals itself. Wealth behaves like physics. Mass attracts mass. Energy compounds when contained. Momentum builds when resistance is minimized. The wealthy understand this law intuitively. Money flows towards systems, not effort. Most people operate financially like open circuits. Income flows in, expenses pull it out, and nothing accumulates long enough to build charge. The wealthy operate like closed energy loops. Income enters, gets redirected into assets. Assets generate cash flow. Cash flow feeds new assets. The loop strengthens. And eventually, gravity takes over. This is the first secret they never share. Wealth is not created in public. It is engineered quietly, structurally, and patiently. But here is what makes it dangerous. The system feels fair on the surface. You earn more. You upgrade. You get promoted. You celebrate. You increase income. You increase lifestyle. It feels like progress. But lifestyle expansion is friction, and friction slows momentum. This is the trap. The wealthy expand assets before they expand consumption. Most people expand consumption before they expand assets. The order alone determines the outcome. And yet no one says this clearly. Instead, society rewards visible success. Cars, homes, travel, symbols. It does not reward invisible positioning. Equity stakes, ownership layers, silent cash flow channels. Because visible wealth creates aspiration. Invisible wealth creates power. There is another layer. You have likely felt it. Is that quiet anxiety. The subtle awareness that no matter how much you earn, it never quite feels enough. Because deep down, income can stop. Jobs disappear. Industries evolve. Health fluctuates. Income is conditional. Assets are structural. And conditional stability creates psychological tension. This tension is why so many high earners still feel financially fragile. They are standing on salary, not on structure. Here is the second secret. The wealthy do not optimize for income. They optimize for control. Control over time. Control over cash flow. Control over risk exposure. Control over opportunity access. Control changes everything, but control requires information asymmetry. And that is why these secrets remain unspoken. Not because they are impossible to understand, but because they are uncomfortable to accept. For example, most people believe debt is dangerous. And for most people, well, it is. But for the wealthy, debt is a tool. The difference is not the instrument. It is the structure behind it. A liability in the wrong hands becomes leverage in the right hands. And that single distinction has created generational divides. But we are only at the surface. There are 7 core structural truths the wealthy rarely articulate publicly. 7 patterns that operate beneath visible success. 7 strategic layers that separate earners from owners. So some of them will challenge beliefs you have held for years. Some of them will expose habits you did not realize were programmed. Some of them may feel uncomfortable. That discomfort is not accidental, because once you see the structure, you cannot unsee it. And once you recognize the invisible architecture controlling financial outcomes, you will never look at income, savings, investment, or risk the same way again. But before we expose the first secret fully, you need to understand something deeper. This is not about becoming rich quickly. This is about understanding why most people remain structurally average, even when they are intelligent, disciplined, and ambitious. There is a design behind average. There is a gravitational pull toward financial normalcy, and escaping it requires more than motivation. It requires awareness of the invisible constraints. Over the next sections, we will dismantle them one by one. We will expose why working harder often strengthens the wrong structure, why status is the most expensive financial addiction, why compounding is misunderstood by almost everyone, why intelligent people still lose financially, why identity determines portfolio decisions more than logic does, and eventually, how to build a wealth engine that operates independently of your constant effort. But not yet. Because before you can build anything, you must first see the architecture you're currently inside. And most people never look up. So here is the question that will guide everything that follows. If the wealthy truly never share these 7 secrets openly, what exactly are they protecting? The invisible financial architecture. Most people think they are bad with money. That is the first illusion. They believe they lack discipline. They blame themselves for overspending. They feel ashamed for not investing early. They assume others simply figured it out. This is where the structure hides. Because the problem is not personal failure. The problem is architectural design. Imagine placing 2 people inside 2 different buildings. In the first building, every staircase subtly slopes downward. The lighting is dim. The exits are hidden. Gravity works against you. In the second building, the staircases incline upward. The lighting reveals every opportunity. The exits are clearly marked. What momentum works with you? Now ask yourself, if both individuals walk the same distance with the same effort, who ends up higher? Effort did not change. Architecture did. This is the invisible financial architecture the wealthy understand instinctively, and most people never see. From childhood, your financial operating system was installed without your consent. Earn money. Spend responsibly. Save what is left. Repeat. This model appears rational, but it contains a structural flaw. You see, it positions savings as leftover, and what is leftover is almost always small. This creates the first trap: reactive wealth building. The wealthy reverse the order. They allocate first. They consume second. This single inversion changes outcomes over decades. But it goes deeper. Your environment subtly dictates your financial ceiling. If everyone around you prioritizes visible consumption, you will normalize visible consumption. If everyone around you discusses salaries, you will obsess over salaries. If no one around you discusses equity, ownership, or asset positioning, you will not prioritize them. This is not weakness. It is environmental conditioning. Humans calibrate behavior socially, and financial norms are socially inherited. This is why intelligent individuals remain financially average, not because they lack intelligence, but because they inherit a limited financial blueprint. Here is the structural mechanic most people never see. Income is linear. Assets are exponential. When you focus only on income, you're climbing a ladder. When you focus on assets, you're building a network. A ladder can only go as high as it is built. A network can scale beyond visible limits, yet society rewards ladder climbing. Promotions, titles, raises. It rarely rewards network building. Equity stakes, cash flow channels, asymmetric positioning is because ladder climbing is predictable. Network building is strategic. This is why most people spend 20 years perfecting employability, but 0 years studying ownership. This is not accidental. Employment creates dependency. Ownership creates autonomy. Autonomy reduces control, and systems resist losing control. Now here is where most people misinterpret this concept. They assume ownership requires massive capital. It does not. It requires awareness first. Because ownership is not a purchase. It is a mindset shift. When you buy a stock, you own a fraction of a business. When you create intellectual property, you own distribution rights. When you build systems that operate without you, you own time leverage. But most people are not taught to think this way. They are taught to trade time. Time becomes currency, and currency becomes consumption. The loop closes. This is the trap. But here is where the architecture becomes even more subtle. Psychologically, humans prefer immediate reward over delayed reward. This is biological. The brain releases dopamine when consumption occurs now. It releases almost nothing when assets appreciate silently. So the financial architecture of society aligns with biological impulses. Consume now. Upgrade now. Signal status now. But asset accumulation requires emotional restraint, and emotional restraint is uncomfortable. The wealthy understand this. They design systems that automate restraint. Automatic investment allocations, structured capital deployment, pre-committed asset acquisition. They remove daily decision fatigue, because decision fatigue drains discipline. And drained discipline fuels impulse. This is why budgeting fails for many people. It relies on constant self-control. The wealthy do not rely on constant self-control. They rely on pre-built systems. This is the first cognitive shift. Stop trying to be better with money. Start designing systems that make better decisions automatic. This changes everything. But we are not finished. There is a deeper layer most people never question. Why does income feel powerful, but fragile? Because income depends on performance. Performance depends on energy. Energy depends on health, opportunity, and stability. It is conditional. Assets, when structured correctly, you are not conditional on your daily output. They operate independently. This creates psychological safety. And psychological safety creates strategic thinking. Without safety, you think short-term. With safety, you think long-term. This is why financial anxiety persists even at higher salaries. Because salary does not eliminate conditionality. Structure does. Now pause here. Think carefully. If your financial life currently depends entirely on continued performance, you're inside the first architectural layer. And most people never leave it. They increase salary. They upgrade lifestyle. They feel temporary relief. Then expenses expand. Dependency deepens. The slope continues downward. This is where shame enters. People blame themselves. But shame is misdirected. The architecture was never designed for escape. It was designed for participation. Participation sustains the system. Ownership restructures it. And that is why the wealthy rarely explain the architecture publicly. Because once you see it, you begin to reallocate energy differently. You stop chasing visible milestones. You start constructing invisible frameworks. You begin asking different questions. What do I own? What generates cash flow without my effort? Where is my capital positioned? What systems operate while I sleep? These are ownership questions. And ownership questions move you upward in the structure. But here is the uncomfortable truth. Seeing the architecture is only step one. Because even when people understand it, they often sabotage themselves emotionally. Why? Because identity resists change, and identity is far more powerful than logic. This is where the second secret begins to emerge. Not in spreadsheets, not in markets, but in behavior. In the next section, we will expose the behavioral finance traps that silently pull people back into the old architecture, even after they understand it. And this is where most intelligent people fall. The behavioral traps that keep you financially average. Understanding the structure is not enough. Most people believe that once they learn about investing or understand assets, everything changes. It does not. Because knowledge does not override identity. Yes, and behavior is governed by identity far more than information. This is where the second secret hides. The wealthy understand behavioral finance at a level most people never consciously examine. They understand that money decisions are rarely logical. They are emotional reactions disguised as rational thought. Let us dismantle this carefully. Imagine two individuals who both understand compounding. Both understand asset allocation. Both understand long-term investing. One builds wealth consistently. The other repeatedly sabotages progress. Why? Because the difference is not strategy. It is emotional tolerance. This is the first behavioral trap. Emotional volatility destroys financial stability. When markets drop, most people panic. When markets rise, most people chase. When peers upgrade lifestyle, most people feel pressure. When income increases, most people inflate consumption. Every one of these reactions feels natural. But natural does not mean optimal. Human psychology evolved for survival, not capital allocation. In ancient environments, reacting quickly preserved life. In financial systems, reacting quickly often destroys wealth. This is the trap. The wealthy train themselves to delay reaction. They do not suppress emotion. They design systems that override emotional impulse. Automatic investments continue during downturns. Predefined asset allocation limits overexposure. Capital is segmented into purpose-driven buckets. Structure neutralizes emotion. Most people rely on willpower fluctuates. Structure does not. But there is a deeper behavioral layer. Status is one of the most expensive psychological addictions in modern society. It rarely feels like addiction. It feels like success. upgrading homes, buying luxury vehicles, taking visible vacations, posting curated lifestyles. None of these actions are inherently wrong, but they often occur before structural stability is built. Here is the illusion. Visible wealth feels like real wealth, but visible wealth is often financed by future income. Real wealth is financed by assets. The wealthy understand that status signaling can be delayed. The average earner feels compelled to signal early. Why? Because identity is socially reinforced. If your social circle equates visible consumption with achievement, your brain interprets non-participation as regression. This is not weakness, it is social conditioning. Humans evolved to belong. Belonging historically meant survival. Now, belonging often means lifestyle alignment, and lifestyle alignment can be financially destructive. This is why intelligent individuals still remain average. Because intelligence does not override belonging instincts. Here is another trap. Few people articulate. Income growth creates psychological permission. When salary increases, the brain rationalizes expansion. I deserve this. I worked hard. It's only a small upgrade. Each decision feels justified, and individually, each decision is small. Collectively, they form a structural shift. Expenses rise. Fixed obligations increase. Optionality decreases. The individual now needs higher income to maintain the same stability. Dependency deepens. This is lifestyle inflation psychology. It does not feel dangerous. It feels progressive. But it reduces wealth velocity. And we will discuss wealth velocity later, because it changes how you measure progress entirely. For now, understand this. Every increase in fixed lifestyle cost increases financial fragility. The wealthy protect fragility thresholds carefully. They do not tie identity to consumption. They tie identity to positioning. There is another behavioral trap, even more subtle. Short-term dopamine bias. The brain heavily rewards immediate pleasure. Used purchases generate immediate feedback. Investments generate delayed feedback. This creates a neurological imbalance. Spending feels good now. Investing feels abstract. The wealthy counter this by reframing investing as identity. They do not view investment as sacrifice. They view it as expansion. Identity-based behavior sustains consistency. If you see yourself as an investor, allocating capital reinforces identity. Or if you see yourself as a consumer who occasionally invests, allocation feels restrictive. Identity determines emotional response. This is the trap most financial education ignores. It teaches tactics. It ignores self-concept. And self-concept governs execution. Now let us address another uncomfortable behavioral reality: fear of missing out. When markets surge, people rush in. When new industries trend, capital floods blindly. When peers boast about returns, a comparison triggers impulsive entry. This is herd psychology. Herd behavior feels safe because it distributes perceived responsibility. If everyone is doing it, it must be correct. But herd entry often occurs late. The wealthy do not chase momentum emotionally. They position before noise. They exit before frenzy. They understand that volatility rewards patience, not excitement. Yet most individuals only feel confident acting when validation appears publicly. This creates a delay. And in financial systems, delay compounds negatively. There is another behavioral dimension rarely discussed: financial shame. People avoid reviewing accounts when performance declines. They avoid calculating net worth when numbers disappoint. They delay confronting debt balances. Avoidance compounds problems. The wealthy confront numbers regularly. They detach ego from data. Data is information, not identity. This separation is powerful, because once ego attaches to performance, objectivity disappears. And without objectivity, strategic decisions deteriorate. This is where most people quietly fail, not because they lack opportunity, but because they avoid uncomfortable data. Now pause. If you feel tension hearing this, tension is not accidental. It reveals areas where identity and logic are misaligned. And that misalignment is expensive. And here is the core insight of this section. Financial success is less about knowledge and more about emotional regulation. Less about strategy and more about behavioral consistency. Less about intelligence and more about identity alignment. But we are still not at the mathematical core, because even disciplined individuals can move slowly if they misunderstand compounding mechanics. They may invest, they may allocate, they may avoid lifestyle traps, and yet progress feels slow. Why? Because they do not understand capital thresholds. They do not understand velocity. They do not understand exponential inflection points. And without understanding those, motivation weakens. In the next section, we break down the math. We model escalation. We reveal why the first phase feels painfully slow, and why most people quit before momentum begins. This is where the third secret lives, not in behavior alone, but in numbers most people never calculate correctly. The mathematics of wealth, compounding, thresholds, and velocity. Now we remove emotion. Now we remove identity. Now we remove status. This is where numbers speak. Because the third secret the wealthy rarely articulate publicly is mathematical. And once you understand it, you will never evaluate financial progress the same way again. Most people misunderstand compounding. They treat it like a motivational slogan. Mouse, invest early. Let your money grow. Time in the market beats timing the market. These phrases are directionally correct, but they lack structural depth. Compounding is not magic. It is acceleration through accumulation. And acceleration does not feel powerful in the beginning. This is why most people quit too early. Let us model this clearly. Imagine two individuals. Person I invests $500 per month at an average annual return of 8%. Person B waits 10 years, then invests $1,000 per month at the same return. On the surface, Person B invests more aggressively, but here is what happens over 30 years. Person A builds momentum earlier. The compounding base grows steadily. Interest begins generating interest. By the end of 30 years, Person A often surpasses Person B, even though Person B invested more per month. Why? Because compounding rewards time inside the system more than intensity later. But here is where it becomes psychologically brutal. When in the first 5 years, the portfolio barely moves, contributions dominate growth. The graph is flat. It feels slow. It feels unrewarding. This is the dangerous phase, because effort appears disconnected from results. This is the compounding valley. And most people abandon the system here. The wealthy understand something critical. Exponential systems appear linear until they do not. The early phase builds base capital. The middle phase builds momentum. The late phase builds scale. But the emotional difficulty is front-loaded. This is why discipline must precede visible reward. Now let us introduce capital thresholds. There are psychological and mathematical breakpoints in wealth accumulation. For example, at $10,000 invested, an 8% return generates $800 per year. That feels small. At $100,000 invested, 8% generates $8,000 per year. Now, the growth becomes noticeable. At $1 million invested, 8% generates $80,000 per year. Now capital begins generating income comparable to a salary. This is the inflection. This is where assets begin replacing effort. But notice the pattern. The difference between $10,000 and $100,000 is $90,000. The difference between $100,000 and $1 million is $900,000. Scale requires sustained accumulation. And this is why most people never reach escape velocity. They misinterpret early stagnation as failure. They do not understand wealth velocity. So wealth velocity is the speed at which your capital base grows relative to your income. Most people focus on income growth. The wealthy focus on capital growth rate. These are not the same. If your income increases 10%, but your asset base increases 25%, you're accelerating. If your income increases 20%, but your expenses increase 25%, you're decelerating. Velocity determines future trajectory. Now here is the fourth secret embedded within mathematics. Compounding works in reverses too. And debt compounds, lifestyle compounds, financial mistakes compound. If you carry high-interest debt at 18%, it compounds against you faster than investments grow for you. This creates negative velocity. And negative velocity feels like running uphill. The wealthy prioritize eliminating high compound liabilities before chasing moderate compound assets. This is structural sequencing. Most people ignore sequencing. They mix investing with expensive debt. They dilute momentum. Well, now let us examine capital stacking. Imagine you invest $500 per month for 10 years. Then, instead of increasing lifestyle, you redirect raises entirely into assets. Your monthly contribution grows to $1,500. Then $3,000. Each layer compounds independently. The early capital compounds longest. The later capital compounds at larger size. Stacking creates acceleration. But stacking requires restraint during income growth phases. And this returns us to behavioral alignment. Numbers reward those who tolerate delayed gratification. Now let us explore something rarely visualized properly. The wealth curve is asymmetrical. The first $100,000 often feels harder than the next $100,000. Why? Because at low capital levels, contributions dominate growth. At higher levels, growth begins assisting contributions. Eventually, growth exceeds contributions. This is the moment most people dream about. But few reach, because the early stage feels disproportionate to effort. This is the psychological test embedded in mathematics. Now we introduce opportunity asymmetry. As capital increases, access changes. At low capital, options are limited to public markets and savings vehicles. At higher capital levels, private equity, business acquisition, real estate leverage, and strategic partnerships become accessible. Capital unlocks access. Access unlocks asymmetry. Asymmetry accelerates growth. This is why wealth often accelerates faster after certain thresholds. Not because the wealthy become luckier, but because capital provides leverage opportunities unavailable at lower levels. This is structural privilege created by capital positioning, and it compounds. But here is the uncomfortable realization. If you never cross initial thresholds, you never unlock asymmetry. If you interrupt compounding cycles repeatedly, you never reach velocity. If you allow lifestyle to expand proportionally with income, capital base grows slowly. And slow capital growth delays escape. Now pause. Consider your current trajectory. Is your capital growing faster than your income? Is your income growing faster than your expenses? Is your capital positioned for compounding or fragmented across consumption? These questions matter more than salary. Because salary does not scale infinitely, capital does. But mathematics alone does not explain failure. Many intelligent individuals understand these models, yet they still do not achieve structural freedom. Why? Because intelligence does not protect against environmental pressure, social programming, expectation escalation, decision fatigue. And this is where the fourth secret begins to surface. It is not ignorance, it is environment. Even brilliant people fail financially when immersed in systems that normalize fragility. In the next section, we expose why intelligent, disciplined, high-achieving individuals still remain financially trapped. And once you see this layer, you will understand why effort alone never guarantees escape. Why intelligent people still fail, social programming, lifestyle inflation, and decision fatigue. Even the smartest, most disciplined individuals are vulnerable. Even those who understand compounding, thresholds, and velocity can fail. This is not luck, yet this is structural. Here is the uncomfortable truth. Intelligence and effort alone are insufficient, because wealth is not just about numbers. It is about environment, psychology, and the hidden pressures embedded in everyday life. Let's start with social programming. From the moment most people enter the workforce, they are conditioned to measure success externally. Friends, family, colleagues, and media define what wealth looks like. A new car, a bigger house, luxury vacations, as designer clothing. This social pressure creates an invisible tax on ambition. Every decision is filtered through the lens of perceived status. Every raise, bonus, or windfall triggers a subconscious question. What will people think if I don't upgrade my lifestyle? And that is how lifestyle inflation quietly sabotages progress. Here is the pattern most people fail to see. Income rises to spending, rises proportionally to capital growth, stagnates, even when they understand compounding. They dilute their own momentum. They accelerate consumption while expecting wealth to accelerate in parallel. It never does. The system punishes impatience and reward fixation. Now add decision fatigue. Every day, humans make hundreds of financial choices. Buy or save. Invest or consume. Diversify or concentrate. Each small decision consumes cognitive energy. Smart individuals often exhaust their mental bandwidth on trivial choices. They react to social cues instead of designing long-term structures. And because human brains are wired to seek immediate reward, they default to what feels comfortable now. Here is the trap. Most people interpret failure as personal inadequacy. They blame themselves. They blame laziness, discipline, or luck. But in reality, they are operating within an invisible system engineered against them. Social norms, environmental pressures, and psychological biases create friction that overwhelms raw intelligence. Behavioral patterns reinforce themselves. You accept social pressure, leads to. You inflate lifestyle, leads to you increase consumption. Leads to you justify your choices with, I deserve it. Leads to your capital stagnates, leads to the frustration cycle begins. Status illusions are another silent predator. Most people measure success by appearances rather than structural wealth. They believe financial security comes from looking wealthy, not actually being wealthy. A $5,000 wardrobe impresses colleagues. A $500,000 investment portfolio is invisible. And because humans prioritize visible rewards over hidden structural gains, effort is misallocated. Here is where choice architecture becomes crucial. The wealthy design their environment intentionally. They remove distractions, reduce social pressures, and automate decisions that do not generate leverage. They strategically avoid environments that normalize consumption. They leverage scarcity to reinforce discipline. Decision fatigue compounds when routines are not optimized. Every discretionary decision weakens willpower. Every unplanned purchase creates cognitive friction. Every unnecessary choice diverts mental energy from compounding and acceleration. And yet, the average high achiever believes they are doing everything right. They read the books. They save some money. They invest in market funds. But the invisible drag created by social pressure, your lifestyle inflation, and daily decision fatigue prevents breakthrough. Now consider another element: comparison trap. We are wired to benchmark ourselves against peers. If your network upgrades lifestyles at every income jump, your brain unconsciously accelerates spending to keep pace, even when it contradicts rational financial plans, even when you know compounding favors patience. This is why many professionals plateau despite high IQ, work ethic, and financial knowledge. The system is not broken. The system is simply weighted against undisciplined behavioral responses. Here is the final layer in this section: cognitive overload. Information about investing, taxes, insurance, and asset allocation floods the mind. Paralysis by analysis sets in. Many fail to act decisively because they fear making the wrong move. And inaction is itself a form of failure. But there is hope embedded in understanding these patterns. Recognizing invisible forces is the first cognitive shift. Awareness allows you to redesign your environment, automate decisions, and prioritize structural gains over social validation. In the next section, we will move from behavioral understanding to tactical architecture. We will reveal step-by-step strategies to translate knowledge, patience, and discipline into tangible wealth. This is where secrets become actionable. This is where knowledge transforms into power. Where abstracts, behavioral understanding, and financial psychology converge into a precise, actionable framework. This is no theory. This is tactical architecture, the blueprint the wealthy follow silently while the rest of the world flounders in guesswork. Let's start with the first principle: capital structure mastery. Most people think wealth is about earning more. Wrong. Wealth is about controlling what you already have. Every asset, every dollar, every investment, a node in a complex system. And the structure of that system determines acceleration potential. The wealthy divide their capital into layers: liquid assets for agility growth, assets for compounding, protective assets for risk mitigation, skill-based investments for leverage. Each layer has a function. Liquid assets are not just cash. They are optionality. They allow swift opportunities without destabilizing the rest of the system. Growth assets are the engine, or equities, businesses, strategic partnerships. They multiply capital over time. But they are not chosen randomly. Each is measured for asymmetry. the potential upside versus downside risk. Protective assets exist to absorb shocks. Insurance, hedges, and diversified holdings are not luxuries. They are structural defenses. Without them, a single misstep can cascade into irreversible loss. Skill-based investments are the multiplier. Acquiring knowledge, building networks, mastering negotiation, understanding systems. These are intangible assets that compound faster than money itself. The wealthy invest relentlessly in skills, knowing that time spent here returns exponential financial leverage. Next, consider risk mitigation and asymmetry. Every opportunity is evaluated through a lens of upside potential versus downside exposure. Most people chase returns without understanding hidden risk. The wealthy do the opposite. They engineer positions where loss is limited and upside is magnified. Here's an example. Instead of betting a large portion of wealth on a single stock, they diversify across multiple asset classes, ensuring that each position can grow exponentially without endangering the system. This is asymmetry in action. Cash flow architecture is another pillar. The wealthy do not rely solely on active income. They design recurring streams, dividends, rental income, royalties, automated business systems. Cash flow is freedom, is dependence on time for money exchanges. It allows for patience, which is the ultimate advantage in compounding. Next comes skill stacking and leverage. Imagine financial assets as the body and skills as the nervous system. Without sophisticated skills, assets lie dormant. With the right stack, every skill amplifies another. Negotiation improves deal-making. Analytical skill improves investment selection. Behavioral mastery improves decision-making under pressure. Timing is another invisible layer. The wealthy understand that capital deployment is not constant. It is cyclical. They exploit windows where risk-reward ratios are asymmetric, often invisible to the uninformed. This strategic patience allows them to acquire high-value positions when others are trapped by fear or greed. Here's a subtle but powerful distinction. The wealthy systematize decisions, as they reduce cognitive load by automating recurring actions. Regular investing schedules, asset rebalancing frameworks, decision triggers. Based on predefined thresholds, automation reduces decision fatigue, prevents emotional spending, and ensures consistency. Now consider the compounding of systems, not just capital. Each asset, skill, and cash flow stream interacts synergistically. Skills amplify investment outcomes. Automated systems free mental bandwidth. With protective layers, safeguard growth. Everything is interconnected. And finally, strategic patience under uncertainty. Most people react to volatility. The wealthy anticipate it. They embrace uncertainty as a design principle, not a risk. They build systems robust enough to absorb shocks while exploiting long-term trends. This blueprint is not theoretical. It is a living, adaptive architecture. It is precise, measurable, and repeatable. In the next section, we will move into the acceleration phase. We will reveal how to transform this structure into rapid, compounding momentum, harnessing dual engines of income and assets to reach velocities few ever achieve. This is where strategy meets momentum, where the carefully built blueprint from the previous section begins to move under its own power, where patience turns into velocity and structure transforms into exponential growth. Acceleration is not about working harder. It is about activating dual engines, income and assets, so they feed each other in a compounding cycle. Most people rely on one engine: their job, their business, or a single investment. That's linear growth. The wealthy combine multiple engines to create non-linear acceleration. Engine 1. Active income. This is not just a paycheck. It is high-value labor, aligned with skill compounding. Every hour spent is calculated to multiply both financial returns and strategic capabilities. Your active income should feed both liquidity and growth assets, enabling the second engine. Engine 2. Growth here lies the multiplier. Investments, businesses, royalties, and other cash flow generating assets grow independently of your time. The key is optionality. Positions that can compound even when you're not actively managing them. This dual-engine system ensures that time is leveraged. Your wealth grows faster than your effort. Next comes leveraging optionality. The wealthy never place all bets at once. They position themselves where outcomes are asymmetric. Small investments with massive upside potential are combined with steady, lower-risk positions. This creates a portfolio that can withstand shocks while accelerating when opportunities arise. Leverage control versus leverage abuse is critical here. Borrowing amplifies returns, but also multiplies risk. The wealthy use leverage strategically, never recklessly. For they calculate not just potential gains, but maximum tolerable losses. Most failures come from uncalculated leverage, overconfidence without a safety net. Timing windows are another invisible engine. Wealth is not created evenly over time. It occurs in bursts when the system aligns with opportunity. The wealthy anticipate these windows, adjusting capital and focus to maximize output during high-leverage periods. This is patience and preparation, combined with precision execution. Next, momentum layering. Every win is reinvested not just financially, but strategically. Success compounds into confidence, skill, and optionality. The psychological effect is massive. Risk tolerance grows rationally, decision-making sharpens, and the velocity of wealth increases. Here's a subtle but powerful point. Acceleration requires feedback loops. Monitor asset performance. Analyze behavioral patterns. Adjust deployment of capital and skills constantly. As every micro-adjustment compounds over months and years into a significantly higher trajectory than static systems. Micro-cliffhangers. What most people miss is that acceleration is invisible until it reaches a tipping point. The system does not scream its growth. It silently overtakes linear models. The richest achieve velocity, while others chase fleeting trends. Finally, acceleration is not reckless speed. It is controlled, measured, and psychologically sustainable. Yet you're building momentum within a framework resilient enough to survive shocks, yet fluid enough to exploit asymmetry. In the next section, we will dive into identity evolution, where the internal psychological shift occurs. The change that allows you to think and act like someone operating at exponential financial velocity. This is where everything internalizes, where the external strategies you've built, blueprints, acceleration engines, optionality, begin to reshape who you are, but not just what you do. Because here's the truth. Most people overlook, without identity alignment, even the best systems fail. Identity is the hidden multiplier. It is the set of beliefs, mental models, and internalized rules that guide every financial decision, often unconsciously. If your identity is tied to scarcity, comfort, or short-term gratification, no amount of strategy can push you past the invisible ceiling. The first step is psychological detachment from immediate results. The wealthy do not judge themselves by daily profits or losses. They measure alignment with long-term principles, compounding, optionality, skill growth, and risk-adjusted leverage. This detachment allows rational, calculated action under pressure, where most people freeze or chase illusions. Delayed gratification becomes a default mode. It's no longer a discipline. It's a core identity trait. Every decision is filtered through decades-long thinking, not weeks or months, until you begin to see short-term discomfort as fuel for long-term power. Next is strategic thought expansion. You start framing life as a system. Your income streams, your asset flows, your skill acquisition, your network all interact as parts of a dynamic machine. Failures become lessons in system improvement, not personal flaws. Rewiring risk perception is another critical evolution. You no longer fear calculated risk. You fear opportunity cost of inaction. This subtle shift changes behavior profoundly. Investments that once seemed risky now appear as necessary steps in growth. Your mental model now favors asymmetry over symmetry, upside over trivial certainty. Behavioral self-sabotage diminishes. Old habits of overspending, procrastination, or identity-based financial fear lose their hold. Your internal narrative shifts from, "I hope this works," to, "I control this system." You no longer compete with others. You compete with your previous self. The compounding of identity and action is powerful. Your daily choices now reinforce your evolved self. Investing strategically reinforces patience. Continuous learning reinforces confidence. Strategic detachment reinforces rationality. Networking with purpose reinforces optionality. Here's the subtlety most miss. Identity evolution precedes sustainable wealth expansion. Without internal alignment, acceleration phases collapse under behavioral pressure. Without rewired risk tolerance, optionality is wasted. Without long-term thinking, compounding fails silently. Micro cliffhangers for retention. The invisible system controlling your wealth is as much internal as external. Identity dictates the trajectory of acceleration, often before external capital even moves. Only after mastering this phase can wealth truly scale predictably and sustainably. In the next section, we'll explore wealth redefinition, how the evolved identity reshapes your perception of money, freedom, and power itself. Now that your identity has evolved, it's time to redefine what wealth really means. Because here's the silent truth. Most people chase numbers, titles, or social recognition, mistaking them for wealth. True wealth is a multi-dimensional system. Freedom, power, and influence intertwined with financial capital. First, freedom beyond consumption. The wealthy understand that money itself is not the goal. It is a tool to buy control over time, attention, and choices. They trade hours for leverage, decisions for optionality, and stress for autonomy. Notice the contrast. A high earner stuck in constant work is wealthy in numbers but impoverished in freedom. Second, power beyond status. Power is not flaunting assets or social media bragging. It's the ability to influence outcomes, redirect resources, and shape environments. With the identity evolution completed, every asset, skill, and network becomes an instrument of strategic influence. And you can orchestrate systems without micromanaging, because your leverage multiplies silently. Third, wealth beyond money. Assets now include knowledge that compounds relationships, that scale reputation, that opens doors, skills that generate optionality, Money is merely the medium through which these forms of wealth express themselves. Psychological reframing is essential here. Every spending decision, every investment, and every negotiation is filtered through this systemic wealth lens. This isn't about sacrifice, it's about alignment. Aligning your financial actions with the structural principles of freedom, power, and control. Environmental awareness amplifies this. The wealthy position themselves where opportunities naturally flow. Industries, networks, and geographies that favor asymmetry. They don't chase trends blindly. They anticipate shifts and position themselves ahead of the system. Emotional mastery now underpins financial decisions. It no longer are choices driven by fear, comparison, or ego. Instead, every action reinforces the compounding trajectory of strategic assets, skills, and influence. Stress becomes a diagnostic tool, not a deterrent. Micro cliffhangers for retention. What most people call wealth is just noise. Your system now perceives the signal beneath. Freedom, power, and influence compound just like capital, exponentially. Once identity aligns, the next step reveals the ultimate challenge: converting this redefined wealth into actionable legacy and unstoppable growth. You've seen behind the curtain. You've witnessed the silent systems, the invisible mechanics, and the psychological architecture that the wealthy guard jealously. But here's the ultimate truth. Knowledge alone doesn't create wealth. It is action that compounds it. Ask yourself, will you remain a spectator in your own financial life? Or will you step into the system that multiplies influence, power, and capital simultaneously? Because this is where the line is drawn. Most people will nod, absorb, then forget. A few will take deliberate steps and accelerate beyond normal trajectories, leaving mediocrity behind. Step 1. Activate your blueprint. Review the strategies, the mental shifts, the compounding structures you've internalized. Every decision must now reinforce your identity-aligned financial ecosystem. This is longer theory. It's the operational system of your life. Step 2. Commit to dual-engine growth. Leverage your income and assets simultaneously. Deploy optionality intelligently. Every move must be asymmetrical, where small actions produce disproportionate results. This is the practical power of the system you've absorbed. Step 3. Protect and multiply. Risk mitigation is not optional. It's a principle. Strategic skill stacking, capital allocation, and environmental positioning are the shields that prevent regression. The wealthy never gamble with system integrity. They engineer resilience. Step 4. Evolve your identity continuously. Delayed gratification, strategic detachment, and long-term vision are not habits. They are lifelong imperatives. Your decisions now encode decades of future compounding. Every action reinforces your trajectory toward autonomous wealth, influence, and freedom. Here's the challenge for you. Implement one structural change today that aligns with this system. No procrastination, no partial commitment. Measure it, adjust it, scale it. The wealthy don't wait for permission. They move first, fast, and strategically. Visualize your future self. See the freedom of choice, the leverage over time, the networks flowing in your favor, and the exponential growth of your assets. Notice the calm authority in decision-making, the clarity in chaos, and the power of optionality at your fingertips. This is your moment. The system is clear. The path is illuminated. The choice is yours. One closing line to remember. You can study wealth forever, or you can become the system that creates it.